It's a line where normally monetary policymakers don't, as a general rule, they don't really comment on fiscal policy. They try to be not kind of directly partisan. But he said, we've used a lot of our tools. There needs to be some fiscal support, right? So he crossed that line in that instance. What I would say now is that what we're seeing on the other side of it is that there's this kind of overflowing amount of fiscal hitting the market. But he's very reticent to comment on the fiscal side because he kind of goes back to the position of not really seeing that his position. But I think at this point, a central banker, if they're trying to be kind of intellectually honest about this, it's time to say it's hard to do any of my mandates when deficits are this structurally big.
Famous macroeconomist Lyn Alden uses a meme of a bus on a rail track with an approaching train to talk about the current state and future of the U.S. economy. According to Alden, the bus represents how markets have traded for the past 40 years, and in another frame, the fiscal dominance train destroys the bus. As Alden says, this bus is everything we thought about the economy and markets over the last 40 years. During that time, monetary dominance happened because most of the money created came from banks lending money. Monetary policy worked well to either speed up or slow down the economy. However, the US and much of the developed world have moved into a fiscal dominance era marked by very large debts and fiscal deficits. As a result, central banks like the US Federal Reserve no longer have the right tools to deal with the situation because raising or lowering interest rates doesn't affect the fiscal side in the same way that it affects bank lending and credit creation. Alden says that in many posts and interviews in the future, measures that were important when money was king are likely to be less important. Alden also said that things are almost completely out of hand because no one will ever think of an austerity program, which is the only real way to fix things and bring them back into balance. A few days ago, Alden and Anthony Scaramucci, CEO of Skybridge Capital, talked on Weibo about how the US economy is going in a direction that can't last and how this will all end. Please like this video, subscribe to the channel, and turn on post notifications to see more videos like this. We will keep sending you clips from the conversation. Because of everything you do, YouTube will reward you and your channel will grow a lot. Thanks.
So in that space, I think we're seeing some broad rotation of political views. We're seeing potential rotations around SEC views. We'll see how that unfolds in the coming days. But basically, for a while, Bitcoin was and kind of broadly the whole space was becoming somewhat of a partisan topic. But we've seen in the past week or so that there's been significant kind of bipartisan shift, a little bit bipartisan support for it. So it's not clean across party lines, which in the long run I think is healthy. Say because I mean that could get invalidated by the end of the day, but basically the people watching it closely significantly increase their odds of it getting approved. Probably the non-staking version. Um, and so basically the ETF holders would not get the staked rewards that basically people that are staking can get. That seems to be a potential line in the sand. I still think it's potentially a little while away before that happens, even though you could get some initial approval starting to come in. I think it's probably in the long run of time, we'll probably see an ETF for it, just because there's already futures for it. Whether that extends to other assets, I think remains to be seen. But yeah, I would guess probably in some intermediate period of time we'd get one, but it's not something I follow as closely as maybe other people follow. Large part of it is recency bias, and so people really tune themselves over what happened over the past 10, 20, 30, 40 years, basically the span of a career, depending on how long they've been in the space. Whereas some of the lessons of history that we can learn about the current period are things that are actually pretty similar to the 1940s, which really only you find in history books and long-term data analysis and that kind of thing, rather than anyone's
Right.
trading career, investment career. And so the
Right.
types of things that, in the modern time, it's people that have managed money in emerging markets. They're often somewhat more well versed on these types of issues sometimes because it comes up more frequently. So part of it, I think, is recency bias. I would note that basically over time, from talking to institutions, from seeing some of the financial media change over time, it is becoming more of an understanding of some of the things we're going through, some of the fiscal challenges we're going through, as well as some of the things that digital assets like Bitcoin or stable coins open up to kind of the current macro situation, how they can be helpful, how they can be disruptive, depending on how you look at it. I do think there's over time there's more and more awareness for these things that I've been covering.
For starters, Alden noticed that reckless government spending and borrowing makes it hard for central banks to do their jobs properly and efficiently. She thinks that we need to have a discussion and take all the necessary steps right away if we want to stop the impending collapse. But everyone who can do that keeps telling the public that everything is fine. The closest Fed Chair Jerome Powell has come to admitting there is a problem was when he said that the U.S. is on an unsustainable fiscal path. Powell's solution is for politicians to have an adult conversation about the problem, which means that the debt is growing faster than the economy, which makes the path unsustainable. That's not controversial at all, and I think we all agree that we need to get back on a sustainable fiscal path. It's time for elected officials to have an adult talk about how to get the federal government back on a sustainable fiscal path. Powell's words make it sound like things aren't as bad as we think, but some experts, like Alden, think they might be even worse. Let's watch the video again.
Probably threatened to resign is the funny answer, but there's actually some truth to it. So, for example, during the pandemic, Powell called for more stimulus. So we kind of crossed the line where normally monetary policymakers don't, as a general rule, they don't really comment on fiscal policy. They try to be not kind of directly partisan. But he said, we've used a lot of our tools. There needs to be some fiscal support, right? So he crossed that line in that instance. What I would say now is that what we're seeing on the other side of it is that there's this kind of overflowing amount of fiscal hitting the market. But he's very reticent to comment on the fiscal side because he kind of goes back to the position of not really seeing that his position. But I think at this point, a central banker, if they're trying to be kind of intellectually honest about this, is time to say it's hard to do any of my mandates when deficits are this structurally big. Because a central bank's tools are primarily designed around accelerating bank lending or decelerating bank lending. That's really what they're mostly geared toward. And we're in a fiscal dominant environment now, meaning that ongoing typical yearly fiscal deficits exceed the amount of new bank loan creation. And so those fiscal deficits are kind of a bigger impact on the economy in many ways than those bank loans, and then they can drive things like inflation. They can drive things like nominal GDP running hot with some of the inflationary consequences that come from that. And basically, it's saying, look, I don't really have the tools to deal with what's happening there, and so if you want those mandates to be in any way met, there has to be a fiscal response. And so right now, it's kind of politically acceptable for central bankers or treasury officials to say, look, in the long run of time, yes, there's a fiscal issue, but but then they always caveat by saying, we still have plenty of room. No one's going to admit that the actual road is kind of running into issues under their watch. And I think that there needs to be more transparency around that issue. So I basically would say, look, if you want me to be able to do my job, you need to rein in yours a little bit. Otherwise, I would resign and say, look, you put in a position where I can't meet my mandate because I don't have the tools to meet my mandates. Question. I mean, part of the reason I say nothing stops this train is because, as you point out, the political incentives don't align around trying to control that any sort of like 2 to 4 year time frame. I guess if someone were really trying to stabilize this, um, it would start with changing the structure of spending around Social Security, Medicare, and defense. You have to kind of go blank sheet of paper. Do we need 800 foreign military bases? Is that keeping us safer or no? And what's the cost of all that? That's that kind of thing. Then it's like, okay, so we have systematically kind of made our food less healthy, and now it's kind of ballooning into really high healthcare expenses on a per capita basis. If you look at Japan, I mean, they're going through a significant aging problem. They're much more aged than us, but they spend something like a third per capita on healthcare and get better outcomes. Well, that is a big contributor to it. It's both it's eating habits, but it's also we have a very processed food industry. So it's not like one group just their willpower gave way over a short period of time. It's the combination of human nature with this very processed um, kind of background structure that makes it all the hard choices are just really really easy to make. So it's our food, both individual decisions, food structure, the way we kind of structure healthcare payments. All of that results in basically just a completely ballooning healthcare expense. Then you can do things like mean test Social Security. I mean, there's ways you can at least try to get that back somewhat on the track. But the problem, I mean, the chance of any of this happening, especially all of it happening together, is exceptionally low. And so I think that's structurally, it's going to be very, very hard for any politician, even well-meaning ones, to do that. And even if they get elected on that, probably as soon as they start enacting some of that, they would not win a second term because the
Okay.
people. The last time that developed markets ran into a debt crisis was really back in the 1940s. We also see emerging markets run into them today, and so combining, kind of what's happening mathematically today, what happened in the past, that gives us some view of what this kind of thing looks like. Obviously, technology is different, culture is different. There's all sorts of details. Basically, I would say that you start to get certain emerging market characteristics in even a developed country when you run into fiscal problems. So it's not like all the crisis happens at once. It's not like you have a pre-crisis and then a post-crisis. Instead, it tends to be a bunch of um, events that kind of culminate together. And so a key thing that it starts out with is the central bank losing control of its own balance sheet, that it's unable to ever kind of retain it back down, and they find themselves structurally monetizing fiscal debt, and always explaining why they're not really doing that, but their balance sheet's, kind of going up cycle by cycle anyway at a faster rate than it used to. And so that's kind of the first step. I would say that we've been in kind of that fiscal dominant situation since around 2019. Ever since we had the repo crisis that probably most audience viewers aren't familiar with, but there was a kind of a financial plumbing issue in September 2019. I would say that kind of marks the probably some of the earlier effects of fiscal dominance. And that wasn't a crisis in the sense that people didn't feel it, but you had that, and then you had the pandemic, and then you had the bank issue of 2023. You had the gilt crisis of late 2022. Um, Over time, these things kind of add up. So basically, what it looks like is the difficulty of hitting a persistent 2% inflation target, which by the way that's only added recently. I mean, their definition of price stability they define as 2% inflation. It doesn't have to be 2%. They could aim for zero, but they don't. But basically, their own target is 2%. The way they measure it, you get a challenge of ever kind of sustainably getting back there. You get money supply growth that is continuing to be significant, an inability to raise rates as much as they want to in the face of persistent inflation, the ineffectiveness of those rates, because again, bank lending is not the main issue. Fiscal deficits are the bigger component of the inflation that's happening. You see more protectionism. You see kind of like narratives like in emerging markets, they'll say, look, it's not our fault the currency's problem, it's outside speculators are attacking it, or people are hoarding it, or you kind of put the blame on some outside entity, or some small unpopular entity. Maybe you kind of wealthy people in general, kind of a vague group, and you say, look, that's why our currency is weakening, the outsiders, the wealthy, whatever the case may
Yeah,
be.
scapegoat. You gotta have a scapegoat.
Yeah.
Yep.
And I think basically you see years and years and years of that. Now, some of the more kind of acute crises happen, for example, in the mid 2030s, the Social Security fund runs out. And so if that's not addressed in some way on either the spending or the revenue side, then basically people would only get a certain percentage of their expected benefits after
Mhm.
that point. It would only be fed by current tax revenue rather than the existing fund. So you start to get these kind of mini crises along the way, but it doesn't just go from normal to Mad Max. It
Right.
basically, anyone who studies emerging markets sees like a slow kind of train of events.
The U.S. national debt crossed the $1 trillion mark on October 1st, 1981. During that period, there were a lot of discussions about an impending collapse, but certain factors, including rapid globalization, a profound period of productivity, with about 1 billion people entering the labor force lower. Interest rates and peak demographics have helped the U.S. avoid any lasting damage thus far. Unfortunately, many compare that period with the situation today, using it as an example to predict that the U.S., especially as the issuer of the world reserve currency, will be able to survive and thrive indefinitely without any consequences. However, Lyn argues that the problems are not only re-emerging today, but the situation has worsened because of the much larger debt to GDP ratio. However, unlike the 80s and 90s, all the factors that help the economy stay afloat are either unraveling fast or happening at a much slower pace than they did back then. The result, Alden explains, is that the U.S. economy is now in a very precarious situation and tilting on the very edge of disaster. Alden says that investors should buy Bitcoin as a hedge against the coming crisis because it is the only asset that has done better than debasement so far. Lyn Alden says that the U.S. economy will do well in the future. What do you think? If you want to see more movies like this one, don't forget to like, subscribe, and turn on post notifications.